Bond ETFs are good for investors who wish to diversify their portfolio while getting some sweet passive income. But there's just one problem. There's literally thousands of bond ETFs available. Which should you go for? In this video, we will be going through, in my opinion, the best bond ETFs that you can invest in, and which is the best one you should go for. As a bonus, I've compiled all this info into this super detailed spreadsheet, which you can download for free, link down below, yeah? Alright, the first bond ETF on this list is the ABF Singapore Bond Index Fund, ticker symbol A35. With an AUM of $1.1 billion, this is one of the largest bond ETF listed on the SGX. This ETF tracks the performance of sovereign and quasi-sovereign bonds. Quasi-sovereign just means a body or a corporation that is separate from the government but still has a connection to the government like your HDB, LTA, Temasek, and so on. The bonds are issued or guaranteed by the government of Singapore, as well as the governments from other Asian countries such as China, Hong Kong, Indonesia, and so on. Though, as of making this video, the holdings of this ETF are mainly issued by the Singapore government, followed by HDB, LTA, Temasek, and SP Power Assets. As such, it shouldn't come as a surprise that the average credit rating of this ETF is AAA, which puts it at the highest credit rating possible. This ETF currently has a weighted average duration of 8.1 years, an expense ratio of 0.25%, and a dividend yield of 2.26%, which coincidentally is quite close to the yield of a 15-year Singapore government security bond. Dividends are distributed semi-annually, and the ETF is eligible for investment using both SRS and CPF ordinary accounts funds. Quick pause. If you are looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry at just 35 cents per trade on the US stock market. It also offers Ireland domiciled ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. Next up is Nikko AM SGD Investment Grade Corporate Bond ETF, ticker symbol MBH. Unlike the previous ETF, which mainly holds government bonds, this ETF holds a mix of quasi-government bonds as well as investment-grade corporate bonds that are denominated in SGD. So if you look at the holdings, you'll see bonds by Temasek, HSBC, Singtel, NTUC, and a whole bunch of other companies. But if you group them all up, it's basically 64% corporate bonds and 35% government-related bonds. Also, what's interesting is that even though the bonds are denominated in SGD, the corporations that issue these bonds may not necessarily be from Singapore. Here, we can see that 66% of the holdings are from Singapore, while the rest are spread across the UK, France, Australia, and so on. The weighted credit rating of the holdings is A, which puts it in the upper medium grade level. Meanwhile, its weighted average duration is 5.73 years. It has an expense ratio of 0.26%, a dividend yield of 3.18%, and the dividends are also distributed semi-annually. And oh yeah, you can invest in this ETF via both SRS and CPF OA. Moving on, the next bond ETF is the iShares Core Global Aggregate Bond UCITS ETF, ticker symbol AGGU. This ETF holds investment-grade bonds from all around the world. So you have bonds from countries like the US, China, Japan, and France. The biggest allocations are government treasury bonds, followed by agency bonds, bank bonds, local authority bonds, and so on. This bond is domiciled in Ireland, so you will only be subjected to 15% dividend withholding tax instead of the usual 30%. But more interestingly, this bond is hedged to the US dollar, which can help to remove quite a bit of the currency risk. For example, if we compare AGGU, which is the blue line here, to the non-hedged version of this ETF, AGG, which is the red line here, you will see that when AGG falls, it can fall a lot more than AGGU due to currency fluctuations. Conversely, when AGG goes up, it can go up a lot more. Because of that, if you are investing in a bond ETF for stability and passive income, AGGU would be the better choice since it has less volatility. The weighted credit rating of the holdings is AA, which puts it in the high grade level. Its weighted average duration is 6.4 years. It has an incredibly low expense ratio of 0.1%, a dividend yield of 3.51%, but instead of distributing dividends, it reinvests them instead. Personally, I prefer this kind of dividend accumulation ETFs, since I get to control how much and when I receive the payments, while leaving the rest of the money it needs to activate the magic of compounding. But if you prefer to automatically receive the dividends instead, then you can go for AGUG, which is the distributing version of the same ETF. Unfortunately, you can only invest in this ETF via cash, but not SRS and CPFOA. Now, you might be wondering, if there's a global bond ETF that's hedged to USD, does it mean that there's also a global bond ETF that's hedged to SGD then? Yes, there is, and it is called AGSGDX, which is a rather confusing ticker symbol if you ask me. But unfortunately, this ETF is not easy to buy because if you try to search for it on popular brokers such as Interactive Brokers, you won't be able to find it. Thankfully, there's another SGD hedge version of this ETF, and it is the Amundi Index Global Aggregate Fund. It tracks the same index but hedged to SGD. It has the same 0.1% expense ratio, its holdings are pretty much the same, and it accumulates dividends too. But there are a few differences here and there. First, this fund is domiciled in Luxembourg, so you'll be subjected to a higher 30% dividend withholding tax. Second, its number of holdings is roughly half the size of AGGU. And third, you can invest in this fund via both SRS and CPFOA. Though for CPFOA, it's cheaper to use Poems to invest since Poems doesn't charge any platform fee for investing in funds, whereas Endowus charges a 0.3% platform fee. But then, what's the impact of hedging in SGD versus in USD? The Amundi fund has a slightly lower dividend yield as compared to AGGU. Its annualized returns are also slightly lower too. However, in return, you'll be exposed to less currency risk, which is a good thing, especially if you are planning to spend the passive income in SGD, because the SGD-USD fluctuation can be rather volatile at times. So then, which bond ETF should you go for? Let's break it down. If you are simply looking for the lowest risk and highest credit quality ETF to earn a stable BP income, then A35 might be the one for you. It offers a dividend yield of over 2% backed by high quality government bonds. However, even with that safety, there's still some volatility risk involved. That's why if my goal is to just earn a stable income with very low risk, I would rather park my money in alternatives like high-yield savings accounts, SSBs, money market funds, or fixed deposits. These options offer a similar 2+% returns, but with very little to no volatility risk. Next, MBH. Personally, I feel this ETF offers a better risk to reward, as it offers a higher dividend yield of over 3%. And since its holdings are denominated in SGD, there's no currency risk to worry about either. That said, MBH has its own drawbacks too. It's fairly concentrated, both in terms of countries and issuers. This means you could be exposed to geographical risk, especially if something unexpected happens to Singapore or the other Asian markets. Touch wood lah. It also only holds around 100 plus bonds, which is relatively small when compared to global bond ETFs like AGGU or the Amundi Index Global Aggregate Fund, both of which offer a broader diversification. But if you don't mind the concentration risk, then MBH would actually be a pretty good choice. Otherwise, AGGU or the Amundi Index Global Aggregate Fund might be a better choice. But how do you choose between the two? It all comes down to the currency. If your goal is to use the passive income to pay for daily expenses in SGD, then the Amundi fund, which is SGD hedge, would be more suitable. But if you are mainly investing in USD assets and want a global bond exposure to diversify your portfolio and easily rebalance when needed, then AGGU might make more sense. So that was a quick comparison between some of the best bond ETFs that you can invest in. Hope it helps you out. Like, share and subscribe as I'll be posting new videos every week.